Hey everybody, it's me, Gregory Mannarino. How are you today? It's Friday, May 18th, 2018. Here's the story, and I want to put a little light on something that I believe you're going to find interesting, that I've been pondering for a while. Here we go. As I'm doing this video blog, stocks are lower. Not by much, but there's a little pressure here, and again, it's all about that 10-year yield. The last time I looked, about 5 minutes ago, it was at 3.089. Okay, this seems to be kind of that line in the sand here, and the market does not like it. Okay, that should be pretty evident to you at this point. Now, if you recall, Jeffrey Gundlach said maybe about a year ago that he believed that the line in the sand regarding the 10-year yield was 2.6%. Well, we're well above that. Jeffrey Gundlach is a very smart guy. I happen to respect his work a lot. Why we have made it thus far past his red line, to me, is very simple. When Jeffrey Gundlach made his line in the sand prediction, again 2.6% for the 10-year, I do not believe that he was considering what would have happened to the dollar since that time. When Jeffrey Gundlach made that prediction, the dollar was stronger than it is now. The dollar has gotten a lot weaker since that point. Now, there's kind of a compensatory mechanism going on here. With the weaker dollar, and I discussed this before with regard to Jeffrey Gundlach's kind of red line in the sand, 10-year 2.6. Again, I don't think he foresaw the dollar would fall as much as it had since he made that prediction. So that compensatory mechanism has pushed that red line in the sand regarding the 10-year higher. It's pretty simple. It's pretty simple. Now, the issue here is the dollar continues to get stronger. So that compensatory mechanism is kind of a seesaw at this point. Is my brain crazy? I mean, I don't understand. I wish I could turn it off sometimes, but it's the truth. So this is what I see going on here. If the dollar keeps strengthening here, it's gonna continue to put a little pressure on that line in the sand with regarding the 10-year. Again, I hate saying that. I hate lines in the sand. But this seems to be playing out to be true. So a couple of things here have a potential to go a few different ways. Let me outline this for you. If the dollar weakens, if we start seeing a weaker dollar, that is going to push that, again, line in the sand regarding the 10-year higher, and stocks will more than likely try to move higher. However, if the dollar continues to get stronger, as it is now, this is going to be a pretty big red flag here for stocks. So we need to watch this compensatory mechanism here, people. It's huge. Between the dollar and the 10-year yield. Very, very important. All right. With that said, this is what we need to keep our eye on with regard to the stock market and with regard to the fake metals market. Again, understand, the dollar, because gold and silver are priced in dollars, where it goes will obviously affect metals to a certain degree. Again, it's not real. There's no price discovery mechanism. It's no secret to you. At least it shouldn't be at this point here. But right now, there's this serious balancing act going on between dollar strength and the 10-year yield. And if we can keep our eye on these things, we're going to know as traders how to put our cash to work. Very, very important. All right, with that said, let's see how this plays out through the rest of the day. And I will see all of you at the end of the day for my post-market wrap-up. Let me know what you think about this compensatory mechanism between the dollar and the 10-year, because I don't think anyone else is talking about it that I've heard of. But it makes perfect sense to me, and I hope it makes sense to you, and I hope it's making sense to Jeffrey Gunlock if you happen to be watching this video, and why I believe sincerely that, not that you got it wrong. I mean, you made that call on the 10-year. I'm talking to Jeffrey Gunlock as if he's watching this, but I don't believe, Jeffrey, that you were considering what the dollar might do at that particular time. All right, with that said, see you later.